All right, welcome back, everyone. Episode 15 of the It's Finance Made podcast. Today, it's all about understanding your total compensation as an international in Germany and how to think about them from a financial planning perspective. Your total compensation has a few buckets. There is salary, there is bonuses, there is equity, and there is benefits. And salary is really about your stability. Bonuses is more about flexibility. Equity is where the upside lies, and benefits are protection or additional upside. So this is how we're going to speak about them. We're going to go through each of the buckets in more detail. And yeah, I think it will be an interesting episode, especially if you're maybe a bit newer to the country or have never really tried to understand your payslip, or if you're prone to getting a bonus and spending it all the next day. Yeah, let's get started with the first bucket, salary. And here we're really going to speak about, how income tax works, how social contributions works, and how to think about it in terms of building your wealth and plan your finances. We're trying to obviously not keep it super dry, keep it a bit more entertaining. And I think we even have a quote to kick it off with. So Kareem, why don't you go ahead?
So one of my favorite authors, he's a economist and author, Nassim Taleb, has this quote which I always really liked, which is, "The three most harmful addictions in the world are heroin, carbohydrates, and a monthly salary." So monthly salary is definitely something that a lot of people in the world are addicted to. It makes a lot of sense, gives a lot of stability. It gives certainty and predictability, right? Like to your financial situation, and like also covering your base needs. So I understand also why it's addictive. It's also an important thing to have. I mean, us three rogue people on this call decided to go cold turkey and give up that addiction, but that's definitely not for everyone. So yeah, I wanted to start talking about salary. I think firstly, compensation.
So what are your withdrawal symptoms?
No, panic, anxiety when you open your bank account.
Okay, sorry for interrupting. I had to ask this question. The quote was too like good to
Yeah.
not ask that,
No, for sure. I mean, yeah, when you build your own business, you hope to build up again to have a monthly salary, but that just comes from your own efforts, right? But yeah, until you reach that stage, there is a lot of anxiety in between, I guess. But no, generally, compensation from a financial planning perspective, also like how we do it in the product. Like we do have like an income planner, and we do also forecasting for your salary and for your bonus, like for the long term. And I think that's also quite an important thing in terms of fitting like the whole picture together about why compensation is important for your long-term financial picture in general. Like understanding how much money is coming in as your income really also determines, like how much surplus you have, how much you can invest, like how much you should put to your short-term goals, how much you can put to your long-term goals, all of these sort of things. So if we talk about salary specifically first, so salary, obviously there's lots of different things to consider when negotiating a salary. Let's start with that. So what you're currently getting, like you should always be also aware of what you could get in the market, not necessarily to move your job, but just so that you also understand how to negotiate your salary in general. It's helpful to talk to friends who work in other companies. Even you can reach out to people on LinkedIn, talk to recruiters, talk to headhunters, like really understand the market salary for the position that you're in. That's really helpful. I think also to look at even in different countries what it might be. It sometimes gives you a little bit of leverage and sort of a better negotiating position if you do talk about your salary to your manager. So I think that's the important thing. Other thing to remember, obviously inflation exists in the world. So you want your salary to be increasing ideally at least above inflation every year. And sometimes it's not always possible. Sometimes companies are not in the best position to increase salaries. So you can also step it, by a bit more than inflation every couple of years. That's also okay. But you want to at least have that. And ideally, as you grow your career, maybe more than that as you gain more skills and, get a bit more experience over the years. When you look at the payslip, salary or gross salary is usually the item at the top. And then Germany has a lot of items underneath which are just minuses. So it's important to just like really understand what these things are and also maybe how you can improve them somehow, which maybe we'll talk about like another day or a bit later. But generally, you have your salary and then you have your income taxes, which in Germany is done on a progressive scale depending on your gross annual salary. Different percentages are applied. It's very dependent on quite a few factors, but generally like your tax class. So if you're single, if you're married, if you have kids, if you don't have kids, you get put into a different tax class. And based on this tax class, you have a different progressive scale of how taxes or what tax rate is applied to you. This tax rate is updated every year. There's also tax-free allowances every year. So I think this year it's like your first 11,000 euros are not taxed at all. And then the tax bracket after that has a different tax rate and so on and so on. So that's income tax. There are things that you can do to reduce income tax in terms of deductions, but that's like a whole other topic. We can go into it one other day. And usually the next item is social contributions. So in Germany, you need to contribute also to the like social system, which is like pensions and so on, healthcare and so on. Usually that is paid half between the employee and the employer. There are different also calculations based on if you're married, if you have kids, how many kids you have, this sort of thing. And that's like always just calculated in your payslip and you can't really get out of it. There's a couple of items that also go above tax and social contributions, which is actually why it's very beneficial. So if you ever heard like in your HR and your company talking about costs that come out of your gross salary, it means that they're paid out of your salary before taxes are applied. So those include like pension. I think company pension sometimes is paid like before taxes and health insurance, I think as well. So that means it comes out of gross, so it's not taxed, so it doesn't include into your taxable income. So company pension, for example, which we'll talk about a bit later, again in benefits, since it's paid out of your gross, it's paid out from a much higher number, which means you benefit a lot more from it. That's very much in a nutshell, but yeah, I'll pass on for other guys if you want to add something to that.
Sure, Alex, you want to go first? I can wrap it up then.
Yeah, I just wanted to build on what Kareem said earlier, right? You have your gross salary, right? Is what you think usually the amount of money you would be getting, and then you have the net salary. That is the money that lands on your bank account. But what a lot of people actually forget that your employer also matches all your social contributions and so on, pays half of your pension insurance and then other benefits that we will talk about later, and they actually pay more than what your gross salary is, right? So with all those contributions, it's actually not just you paying it, it's also your employer. And that is something people often forget when they compare, for example, their current salary as an employee with how much money they would need to make as a freelancer, right? It's costs that actually that you should consider because they go up, right? If you do them yourself, if you pay your full health insurance, then all of a sudden it's twice as much. So you actually need to make more money if you start your own business because you only paid half so far of those social contributions, right? And all of a sudden, like you're not just paying 400 euros, you're paying like 800 euros all of a sudden for health insurance. And that can really hurt, especially if you haven't been aware of that before. And if you haven't used that for your calculation of how much money you would need to make as a freelancer. So their financial planning is actually very important.
Yeah,
Yeah.
totally agree. And just to add to that one, like, yes, as a freelancer, I think these costs are underestimated. But then even if one day you're thinking of having a business and employing people, like that's also something to keep in mind. Like that's something that we face now, right? Like, because if you think like, oh, well, I make 60K a year, so I can, if I make a business and I hire someone that also makes 60K a year, then I have to pay 60. No, you actually have to pay a lot more, right? Like, because when you employ someone, you as an employer need to pay these costs on their behalf.
Yeah.
There's something to keep in mind.
And just to give a range here, I think it's usually around like the actual sort of percentage around that is like 12%, 13% in addition.
Social
So if
like 22.
yeah, no, but they're like what the employer then like pays. Like, so for example, if you like you negotiate an annual salary of 60K, like the employer will probably pay like 66. for that overall. Yeah, so that's a very important point. I would have added that as well. So that's a very good thing also if we can speak about a bit more about negotiating your whole compensation package at the end. But that's to me also a very important point to consider, and it's really good if you can proactively like sort of bring that into the conversation. Like, hey, I know you guys pay more, so you're aware, because a lot of people are not aware of this. And the other thing is also, with knowing all of the 4 compensation buckets, one question that I thought of earlier that I actually also never asked, but now it comes up, is if you're in a job interview and you're negotiating the salary or the compensation packages, you could also just ask the question, hey, out of these 4 packages, which one can you do the most? Like, are you the most? Because companies are very different, right? Some companies like go heavy on the equity. Some companies go heavy on the benefits. Some companies go heavy on salary, and some companies and jobs and roles go very heavy on the bonus. So that's actually a interesting question. I thought if anybody asked that in a job interview, let me know how it goes. I would be interested. And the other thing I want to mention, then it's the last point of salary, is there's the public health insurance and there's private health insurance. And if you start on the public one, which is mostly the case, if you climb above a certain salary, then the 50% contribution that your employer pays, you have to pay yourself. So then your contribution towards health insurance goes up by a lot, and you'll definitely feel it. I think it's around 66,000 in annual salary. Then public health insurance becomes much more expensive than before that. So that's where sort of some people also start thinking about private health insurance and what sort of the differences is, and if it's good for you. We could answer that in the process, but it's a bit too much for here. Just so you're aware, that's part of it. So yeah, there's a lot of taxes, as we all aware, in Germany that go away, and there are some things you can do to reduce income taxes. But yeah, in terms of how we think about it, it's like, hey, it's about stability, it's about security. There's a tax reality, but that can be planned, and that's really how you should look at it. There's like some monthly thing that you can work with, and it's a bit more plannable. Moving on to the next, that's maybe a little bit less plannable, is bonuses. They are a bit more flexible. There's usually either fixed bonuses or variable bonuses. So you either get, like, in Germany, there's also something called the 13th salary. It's a very German company thing. I don't know if you guys have ever gotten a 13th salary. Did you?
Apparently in Austria, it's 14, actually.
Yeah, crazy.
Yeah.
Danny told us, right?
Yeah,
One of our
yeah.
friends is Austrian. Yeah.
14
Have you
means
ever gotten
You get 2 months extra.
you get 2 months extra, yeah. So there's the 13th salary is, I got it once. It's usually like, okay, you get it at the end of the year in December or in January. I think I got it in December.
Yeah.
For like an extra sort of like Christmas money, just like an extra salary at the end of the year. Yeah. It is calculated still obviously in your annual salary. It's just divided by 13 then, and not by 12. So there's a little bit of a delayed gratification, maybe. Sometimes can be good, sometimes can be bad, but that's sort of how it works. But yeah, that's how bonuses can be fixed, variable, and obviously that depends a lot on the role also that you have in the company. Often salesy positions or salespeople have like a low base salary and a high bonus package, and maybe other roles have a bit more of a fixed bonus. But yeah, Alex, maybe you can shine some light on how we, from a financial planning perspective, think about bonuses.
Yeah. Let me start with taxes, because we're just talking about that topic. So
Yeah.
Karim already explained the income tax in Germany a little bit, and bonuses are part of that income tax. So they are part of your compensation, so part of your income. So you pay income tax on them. But a lot of people think about the bonus as being highly taxed, and the reason is that there's also something called a marginal tax rate. So it's the tax that you pay on the next euro you're earning. In this case, bonus usually comes on top of your regular income. That means it just feels like it's taxed higher because, like if you already earn, let's say, in the highest tax bracket with your base salary, then every year that you earn on top of that is already taxed with, like at the moment 42%. That means you get your bonus on top, and that is then fully taxed with 42%, which feels like at the end of the day there's not very much left of your bonus, right? If you ever got a bonus and you heard the number of your bonus and you're like, yeah, I'm getting a lot of money, and then all of a sudden, just almost half of it disappears. That can actually feel not so good, I would say. And so that's the tax. Then I already mentioned that you have different kinds of bonuses, right? You can get things like a sign-on bonus, you can get performance bonus, you can get retention bonuses. In the end, it's just a different form of like what the trigger is for getting the bonus. For financial planning, for us, it's relevant that we really figure out how regular your bonus is and how dependable it is. If we take it into consideration for your regular planning, or if it's something that is rather disregarded, right? And if you actually get it, great, then we have some rules for it, right? Then we really have, rules what to do with it. So you don't just spend it and have just some lifestyle creep there. And if it's dependable, we can take it into consideration for your normal financial planning and use that for your overall financial plan just as income, pretty much.
I actually want to say something here. I think it's a very important topic, that like sort of a bonus without a plan disappears into lifestyle inflation.
Mm.
And the statement itself has a negative feel to it. But the thing about financial planning is it's not judging your behavior so much. It's about, you can plan to spend it all, or you can plan to invest it all, but planning either of them is just the important part. So if you spend it, you're fine. But then because you plan for it, you can like have less negative emotions attached to it after. Because a lot of people's like, oh fuck, I spent all my bonus on like, I don't know, traveling somewhere, or buying something I don't necessarily wanted, whatever. And then they like feel like guilty and, oh fuck, I should have invested it, whatever. But if you do the planning and say, okay, I'm getting this bonus, I'm gonna, spend 60% of it and 40% I invest, or I'm gonna spend 90% of it because I've always wanted to do this, and this is like one of my goals, one of my life events. It's on the timeline. Then there's so much more intention behind it, and you'll feel so much more better about it. So that's just a point that I wanted to make here.
Yeah. Planning and conscious decision making actually makes a big difference here. Like once the money is on your bank account and it's just not planned for, then it's very easy to just think about it in the way of like, oh yeah, there's money on my bank account, and I always wanted to buy this or that, and then you just feel like now is a good time just because there's a little bit more money than usual, right? So if you already have a plan, that really makes a big difference in how useful that money ends up being for you, and not just for short-term gratification in that moment.
One other thing that I have, but you go first, Karim.
One thing is planning the bonus itself, but another thing is also planning your overall financial picture with or without the bonus, because I think it can also be dangerous. For example, if you have a big variable component to your bonus that's like related to performance, or related to if you hit your sales targets or not, or related even sometimes to company performance, which you can't even hold, right? So we tend to push our clients, like if they have, especially if they don't have a big gap between their income and their expenses, which we call the surplus, to not fully rely on these sort of variable bonuses that can change to plug that gap, because then you could also be in trouble if for some reason something happens, like in your company, in the market or whatever, and for that year the company can't pay out bonuses. So you don't really want to be dependent on it. Like I think Daniel framed it very well. Like bonuses give you flexibility, not stability, right? So you want to plan your stability with your salary, and the bonuses give you the flexibility on top.
Yeah. And one other interesting thing I just remembered from my time when I got bonuses is I had a pretty big bonus actually, like, and then that month of payslip, right, sort of like gets screwed. Right. And I actually want to verify this with you, Alex. You probably know the most about the specifics. But my assumption was then, so let's say your base salary is like K gross per month. and then you get like a 10K bonus. So for that month, it's 16K gross. So what that payslip then does is it doesn't look at your annual total compensation, but it looks at what do you get that month, and then sort of times that by 12, and like the money goes away. So you actually overpaid in that month, and you like at the year end, you can probably get like some money back from that. Let's say it's not false I don't know. Am I right with this, or is it wrong? But because it feels like like that month where you get the bonus, like the taxes are like it's so much higher than usual.
It definitely does feel like that. I would say like that is something for a tax advisor if you have a very in-depth question of your payslip, because it does get very complicated, right? Like, and I don't know what kind of bonuses it is and so on. I'm also not too much in the weeds to really just give a generic answer on everything, because I mean, every payslip that you look at, it has some basics, but when it comes to bonuses, like,
there's different structures.
There's so many different structures.
I think it also really depends on each company, how they set up their payroll system and where they actually enter information and all of that.
Yeah. But I remember because I then did that tax return for that year, and I like got a lot back actually. And I think it's because of that, because I just overpaid in that 1 month where I got like a bigger bonus.
Yeah, makes sense.
And I got a lot from like that back. Okay, let's move on to the next bucket, which is equity, sort of like long-term incentives, where the real upside is, or where the real sort of potential is. And there are different types of equity forms. And Karim can go into depth there. He has a lot of knowledge about it. But there, just to introduce the bucket a little bit, there's RSUs, so restricted stock units. This is if you work at a company that's publicly listed on the stock exchange, you can get sort of restricted units, and they get unrestricted in a certain time frame, and then you own them, and you could like sell them. And then there's some ESOP and VSOP, which is some virtual shares and some actual equity, but that's very startup-y or scale-up-y, let's say. And yeah, so these are the buckets. Maybe from here I'll give it to you, Karim.
Yeah, equity is a topic I looked into a lot in my career at different stages. I mean, in banking, I even worked in the equity capital markets team, so really like doing IPOs and rights issues for companies. And then in the startup world, like really from seed rounds, doing the whole like cap table, which is basically the equity table of who owns what, and doing financing rounds and so on. So I have a lot of different, and of course, as an employee in those companies, also got equity in those companies. So I have a lot of different varied experience around equity. As Daniel was saying, is very, very different if you are employed in a public company, in a private company that is growing, or in a even like just private company that's like a Mittelstand or something, where you probably won't get equity. But so it's important also,
like these family-owned businesses, right? Those usually that they don't give you any equity. Yeah.
No, exactly. But like, it's important to know that if that's not part of your compensation package, then maybe, you can push on the other ones, because like you could get something in a different job that has equity, right? Equity, again, I think it's very important to think about how close the equity can be to cash. The ones that are very far away from cash usually have potential for more upside. It's not always going to turn into cash. Whereas a public company that gives you RSUs, the likelihood, at least if you stay in the job, that they can turn into cash is very high, right? Like, because there's a market, you can actually sell them. So I think when you're considering them, especially in very, very young companies, they try to sort of compensate for the fact that they can't pay a high salary by giving you a high equity package, and tell you, oh yeah, in 5 years, this company is going to be worth blah, 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 and your equity is going to be worth blah, blah, blah. And it's sort of like, yeah, take it with a grain of salt. We've all been there. We've been burnt. Like some people made it also a lot of money. So again, it's really much, much, much more volatile. But yeah, starting with public companies, I think that's like the situation for most of our clients, more working in public companies. RSUs are a really, really nice tool in a way, it's kind of a bonus, but it's more attached to the company's performance. Usually There's something called vesting. So the longer you stay in the company, you get granted shares or the ability to buy shares at a discount to the market, depending on the program of the company. On these vesting days, you basically receive shares. Usually, the exchange or the platform which you're issued these shares already take away the taxes, because RSUs are taxed income tax on vesting day, and usually you receive the shares minus that. So just to be aware also, like what sort of is written on the program or on the paper, you will receive it after tax usually. Then what you can do after you receive the shares, you can decide to keep them or you can decide to sell them. These are lots of different strategies that you can do. Like generally depends on your life goals, but in terms of us for financial planners, you are already taking a risk on the success of your company just by having a salary with them. So by having a salary and then holding on to a lot of stock from that single company is taking a lot of risk on one company. And we really would, think about, like, if you really want to have that much risk on one company, we generally would more lean towards selling it and diversifying it, as in investing it in ETFs. There's lots of different strategies to do that. Gets complicated. If you want to talk about it in more detail, book a call. We'll go through your individual situation. Other things with RSUs to be aware of, there's also blackout periods or lockup periods. So when companies in general do earnings releases quarterly, they have a big one annually before they're going to do a big equity issuance, even not an IPO because it's publicly listed, but like issuing more shares or issuing or maybe sometimes there's like M&A activity. They do like this lockup period, which means you can't actually sell your shares for someone working in the company. It gets more extreme if you're management in that company because you have insider information. These rules are very strict. It's not possible. If you trade in that time period, you go to prison. It's insider trading. So you need to really be aware of those periods also when you receive your equity so that you can make sure that you can sell them. That's RSUs. Again, there's a lot more to it. We can go into it in more detail based on your individual situation. Just quickly on ESOP and VSOP, there's lots of different ways that they're done, but these are more for startups usually or growth companies. As I said, they can have a lot of upside, but there's also a lot of complications that can happen there. Taxation can be also quite weird. That's why in Germany, most do this virtual stock option program, which is not actually a financial instrument. It's a company policy, which means the company can actually change it. So there's a lot of weird stuff that can generally happen with them. But yes, they can give a lot of upside, but definitely from a financial planning perspective, if you're looking at actually achieving like life goals, it's really hard to plan for them. They're sort of more like moonshot thing. Like if they happen, great. If not, then really don't take them into account. Another just last point, some companies, and this is a trend in the last few years, especially growth companies, there's been a big trend of companies staying private for much longer than they used to be. Like the average timeline for like especially tech companies going from founding to IPO was maybe around like 6 years to allow like the investors a chance to liquidate. Now it's 10 years plus. So what companies started to do is this thing called secondaries, which basically means, or buybacks, share buybacks, where the company themselves buy back your ESOP or your VSOP from you and give you cash before the company actually goes public. These are actually can be quite good because it allows you to benefit from the upside without having to wait for the uncertainty.
I think Revolut has done that like the third time now or something like this, right?
Yeah. Bunch of companies are doing it.
Yeah. I think that's a very, very great tool. That also, obviously, if you then, publicly market that you do that, it also pushes a lot of people to take that equity as part of their compensation and maybe have a lower salary. But yeah, it's a very good point.
Yeah, like RSUs are a super interesting topic because it's also an emotional topic, right? And they are designed for retention. They're really there to keep you as an employee, right? That's also why you have a little bit of time until you actually can sell it, and that really depends, I think, on the company, right? Like how long that time is. I actually don't know if there are specific rules. Maybe Kareem, like if the company can completely design if you need to hold the stock 3 months or 3 years, if that is completely up to the company. If
The
it's
vest, you mean?
vesting period, yeah, exactly.
It's up to the company, but there's market standards, of course. So, like, companies don't deviate so far from the market standard because then you won't accept their offer, kind of thing.
Because I've seen both. I've seen clients of ours with 3 months, which I mean is pretty great, I would say. Then the risk is a bit lower that if you get the RSUs that you can actually unlock the money relatively quickly. So it's not super volatile. But if it's very long, then there is a lot of risk that Karim already mentioned, right? Then it's not just your salary, but for 3 years, it's probably a significant part of your compensation is then actually dependent on just one company's stock price going up and down. And 3 years is a long time, a lot can happen. So that makes it also, I would say, a bit harder to decide if you, like, for example, sometimes you have the option to get more stock in your company, and that I think becomes harder the longer actually that period is. And the other part is, I think, selling, right? We said it's good to have clear rules and probably diversify. Like, generally speaking, of course, it always depends on the personal situation. But what I've seen that is very difficult for some people actually to do so, especially if the performance of the stock has been going up and up and up. So you got your stock, you've seen it rising, you've seen your your wealth going up with the stock price, and then selling it, right? This is very difficult because you have the fear of missing out, right? What if it keeps rising and you kind of miss this incredible, rise of your company, and you sell too early and all your colleagues hold on to it and you're the one that actually sold early. So that I've seen quite a bit, and I've seen also clients have a significant part of their wealth in their company shares, especially if they worked for companies that have done really well in the last few years. But yeah, so in the end, it's a topic of like how much risk do you actually want to take, and I think our job is to really make sure that you're aware of that risk and put it into perspective, and then look at what your financial goals actually are and what the best strategy is to achieve your goals.
Yeah, and deciding for the risk or against it, right? Like that's sort of the planning approach. It's like, hey, now what's going on, and you can decide either way. It's up to you. Like these total comp packages, like usually the higher you get in like sort of like Google, Meta, I don't know, like Delivery Hero, Alt/DoorDash, like the higher you get, and especially if you like enter the company as a VP or head of or director, senior director, whatever. Often the base salary doesn't increase that much, but the total comp varies a lot. Like I've seen people at Google, like engineers, like if they join as a very high engineer, they're like their base salary is still around the 150 to 200K mark, but then they get like 600,000 euros a year or like to $1 million in stock equity, right? And that's obviously like a lot. But yeah, like let's wrap up the RSU topic because we still have one bucket to go, and I think we summarized it quite well now. It's very exciting, the equity topic, but there's some management of the excitement to be made.
Yes.
That's how I'm gonna end it. And in terms of benefits, that's often sort of a little bit of a hidden layer in German compensation because it might be different from like the country where you've worked before or like other sort of schemas that. But benefits include everything from your employer pension, betriebliche Altersvorsorge. It include some health insurance contributions. It can include relocation, meal vouchers, transportation subsidies, gym subsidy, your urban sports club in Berlin or whatever it is. It can be lots of different things, financial well-being, support, right? And sort of there's a whole list of things that what companies can do.
Or the typical Berlin startup is like fruit bowl and muesli in the morning, or what?
For example, yeah. And urban sports club is also very common, I think.
Yeah.
But yeah, so that's it is a much bigger part of your total compensation that most people think. I think that's the sort of the point that we also want to make.
Yeah.
That there can be quite some hidden gems in there in terms of your total compensation. And often these benefits are also on the company side good because they can also deduct it from their taxes. So negotiating benefits might be easier than you think. But maybe we'll like start with the biggest one in terms of like financial upsides is your employer pension or your company pension. Maybe Alex, you want to kick that one off?
Yeah. Like benefits is an interesting topic, as you said, because it's also interesting for your employer. They like instead of giving you a salary, like they don't have to pay them tax on the social contributions, so it's cheaper for them, right? So instead of giving you 100 euros more, like giving you 100 euros in a meal voucher or like company pension, is actually a lot less money for them. So it's interesting to have an idea of what your company is actually offering. Like one thing that companies definitely offer, at least if they are more than a handful of employees, is, as you said, it's company pension. So that's something you can be relatively sure that your company is offering it. And they also have to, by law, tell you about it and inform you about it. So that is something you should be hopefully aware of. Some companies do a better job at explaining to you their company pensions. Others just brush it off a little. Oftentimes that already is not a good sign, because that probably means, the company pension is not the best. Companies' pensions vary quite a bit in quality. And what I can generally say is that bigger companies, especially if they have a strong workers' union, do have quite good schemes for employees, generally speaking. And smaller companies, especially the ones, like startups, usually they just brush off the topics. They do the bare minimum and don't necessarily focus too much on if what they actually offering is the best for their employees, because
I think it's also a lot of overhead for them, right?
It's overhead.
And we talked about that earlier, that startups then rather choose the equity bucket, and that's also like in terms of attracting talent. People who go for startups, especially earlier stage, are also a bit more on the risk taker side, so they like the equity more than company pensions, right? So I think there's a like demand versus offer sort of dynamic at play also. It's not just saying that startups are like, why do they not do company pensions?
No, it's about like also the incentives, right? As a startup, people join startups because they want to build something, they want to participate from the growth of the startup and from their work right now, right? And for established companies, like if you take the time to actually develop a person, you would want to, and probably want to keep them, right? Like you have some stability and you would want to keep them around. So like you offer them something also for the long-term future, because often people then also imagine themselves working much longer for an established company than for a startup, right? So like it makes sense that startups focus a little bit less on the company pension, a bit more on the equity, for example. But just for people to have an idea when they join a company of what they can expect, right? What kind of quality they can usually reckon with, and if it would make sense to really go into a lot of detail with the company understanding the product. Overall, company pensions can be very vastly different. It's an umbrella term. It has some basics, that the basic structure, but the products underneath can be very different. The basic structure is you get money out of your gross salary, right? So before tax and social contributions that you contribute, for example, to this pension, and your employer also then doesn't have to pay the contributions on their side. So it's also good for them. And because they don't have to do that, they do have to match this contribution. And the legal minimum for this is 15%. If they only do 15%, actually, then they do save more on social contribution than they are using for matching your contributions. So 15% is actually for the company in the end a benefit more than anything else.
It's a good way to frame it, actually.
Yeah, like they make, it's more money in their pocket because it's cheaper anyways. But yeah, so how it works is you take your money out of your gross salary. You don't have the tax and social contributions, like on that contribution, but then later on you fully tax. So like company pensions often can look very good when you just look at how much your contribution is and how much it's actually taking from your net salary. But you should be aware that those benefits can have also negative consequences on the long term. So it's very important to actually look at it from a financial planning perspective, not just how much money are you actually contributing to your pension scheme, but also what's the payout and what's the tax structure at your pension age, right? So it's really something that, like when you're looking at those products, that you should look at holistically, and that you should look over the complete timeline, which can be tricky. And there it's important just that you have somebody that can explain you the product that you're having from a neutral point of view. Because for company pensions, if it's an insurance company, usually talk to somebody that wants to sell you that product and oftentimes gets a commission. So that's, again, why it's good to get a secondary opinion. If you have somebody at your company that can explain you the terms exactly, then that is super helpful. If not, then it makes sense, I think, to talk to somebody neutral that explains to you the product in detail and shows you what the implications and the payouts actually are.
Yeah. To sum it up, company pensions can be very tricky. They work you contribute from your gross salary, and there's an employer matching contribution. The higher, the better. The minimum's 15. It can go up to a multiple 100%. I think they're quite flexible there. And then what's important is to look at behind the curtain in what the company pension actually does, what's invested, what it is investing in, when you can get your money out. And one other point is also like how they work in terms of when you actually leave the company or when you switch companies, right? Like some of them you can take to a new company and they will continue it, but mostly they don't. So then you need to have a strategy. It's like, okay, is there a possibility for me to stop contributions and it's just gonna, run until I retire and then I get money. So these are the factors that you need to consider for that. Are there any other benefits that we want to or need to highlight here? I think company pension
I think quickly
now.
I think quickly, there's generally a lot of the other benefits also more contribute to like expense reduction. So, for example, a quite popular one is like company car, which I think is very attractive to a lot of people because you can get a car basically from the company, you can use it. There's different like policies around it in every company, but like generally that has a big reduction on your expenses because if you would lease the same car and pay it personally, it would be like quite expensive. But you get it for your company very reduced or almost or sometimes for free. I mean, some companies do like private jet access and stuff, which also just expense reduction at the end of the day, right? So yeah, like I think for those, it's just always like be careful, right? Like because they're designed in a way to make you stay in the company and to not leave, right? Like so that's just something to keep in mind. And then also when you do leave the company, if you don't go to another corporate that has the same policy, like just plan sort of that impact it will have in your expenses if you want to keep the same lifestyle.
Yeah.
And
Great.
then there's a bucket of insurance. Benefits can be also insurance. Some of them you have by default as an employee, like sick leave is, for example, something that you do have as an employee. The first 6 weeks you get, a salary continuously from your employer. It's something that is easily forgotten. People don't necessarily think about it; they take it as given. But once you actually starting your own business, people forget about that very easily till they're actually sick and they're like, like they don't know where their income for that time is then going to come from because they didn't budget for it. They didn't expect to be sick and not being able to work, not making to make a living. As an employee, it's something that's being paid by your employer. And then there are also other types of insurance that your employer can actually give you as a benefit. Usually, it's a group contract. And there's some benefit to it to give it to the entire company because, for example, there can be health insurance, additional health insurance, private health insurance coverages for you, or accident insurance contracts, or occupational disability insurance contracts that the company can get for every employee that works for the company. The benefit here really is that they're pretty much no health questions, because oftentimes for those insurances, if you were to get them yourself, you would have to be healthy. And if the company gets it for all their employees, then, they can also insure people that have issue with their health. And so that is actually very nice. The one issue that, if we look at it, that usually comes up is what happens if you leave your employer, right? What happens if you actually, get this insurance through your employer and then you leave the company. And by then you're 10, 15 years older and you're actually not healthy anymore. That can become also a risk. It's something when we do financial planning to at least talk about, be aware about that this kind of creates also some dependency. So because the coverage then goes away with the employer. So that's kind of, I mean, it's one of the reasons why employers also offer it, right? It's retention. So that is fair, but it's good to just be aware of it from a planning perspective.
Okay, so I think sorry to interrupt.
Yeah.
But I want to make sure that we sort of get through and wrap it up in time. So is there any like last benefits that you want to add? I think the categorization that Karim did was actually really good. It was like, hey, there's benefits that focus more on like reducing your expenses, and then there's benefits that help you build wealth in the future and like ensure sort of like a future income. And yeah, they're really also like a tool from the company to keep you in the company. Like I think that's a very good point you made, Alex. Like sort of a retention schema. That's also why there are compensation managers to design these things, because retention is a very, very important topic for every company, because hiring is very expensive and it takes a long time.
Yeah. I think there's one interesting one that especially like big corporations set up. It's an early retirement savings plan. Especially interesting from a financial planning point, because you can decide to forego income now, and then the company invests it for you. Oftentimes they give you already like a fixed interest rate for it. And then what you get is you get your salary without working at the end. So I think that's a very interesting one, because a lot of people would want to retire a little bit earlier. And the question is it better if you take the salary and invest it yourself, and then just, like have the flexibility to spend it on whatever? Or is it better to take, like to forego some salary now, and the company invested for you, gives you some guaranteed interest rate, and then just tells you like, hey, pretty much if you keep this up, then you can already retire like 3 years earlier, and we pay you the full salary at the end. So I think that's also a very interesting one, but I've only seen that at big corporations. But there are like, I think the point is to figure out what your company offers, right? This is often something that is not very clear to a lot of employees. Like, what are all the things that I could actually be doing, and how do they work? Because oftentimes there are a lot of different things that the company offers, and it is something that in some companies you actually need to find out proactively. But as we just discussed, it can be actually very worth it.
So let me wrap this up. We talked about the 4 buckets. We talked about salary, which is really about stability, planned income. You can cover your expenses. You can see how big your surplus is and think about what to do with that monthly surplus, invest it, build up some cash pile to, achieve a certain life goal. Then your bonus is really about flexibility. It can add to, achieving your goals faster. It can also just be, a nice spending boost and doing things that you like to do. And then equity is really about upside. Here you really need to understand the risks and have the right mindset of, okay, like what sort of equity is it? Is it public company? I can sell it every 3 months. Is it something that, I might only benefit in like 5 to 8 years or even longer? Is that something that should be a big part of it? Like, do I believe in it? Obviously, people who succeeded with that are more in the news also, like, oh, this person was one of the first people at Spotify and now they, their equity is worth like millions. Cool. But it's a very low percentage. So it depends really on the company that you're in and the growth trajectory of that. And then the last bucket is benefits, which is protection. Maybe I would actually reframe it a little bit and say it's like about expense reduction and future income opportunities, and really have like these 2 sides in mind. Yeah, that's like sort of how we think about it from a financial planning perspective. And if you have any questions about financial planning, if you want to experience it yourself and you want to like really get ahead and get some financial anxiety out of the way and gain more clarity and see like what sort of opportunities you have, then feel free to check us out, book a discovery call on financemate.de. we're happy to also show you the new product. We launched a new version, Finance Made 2.0, everything in one chart, everything in one product. And yeah, it was a fun episode, guys. I think we hopefully covered a lot. You learned a lot, and let us know what other questions you have. See you next week. Bye-bye.